Welcome. Today, we're diving into the world of accounting systems, focusing on the single entry system and how it compares to the more advanced double entry system. Whether you're a small business owner, a student, or just curious about how businesses keep track of their money, understanding these systems is crucial. We'll start by exploring why double entry is the standard in most countries, but also why single entry still has its place, especially for simpler operations. Let's set the stage for a journey through the basics, practical examples, and the real-world impact of these accounting methods. Single entry accounting is a straightforward way to record financial transactions. Think of it as keeping a simple checkbook. You note down money coming in and going out, but you don't track every detail. This method is perfect for very small businesses or individuals who don't have complex operations. There's no need for complicated ledgers or balancing multiple accounts. However, it does have its limitations, especially when it comes to tracking assets and liabilities in detail. Let's see how this system works in practice and why it might be enough in certain situations. Contrast, the double entry system is the backbone of modern accounting. Used in all advanced countries, it ensures that every transaction is recorded in two places, once as a debit and once as a credit. This method provides a complete picture of a business's financial health and is essential for calculating taxable income. Double entry helps prevent errors, detects fraud, and keeps detailed records for owners, investors, and tax authorities. While it's more complex, it's necessary for businesses with multiple assets, liabilities, and owners. Let's break down how profit is calculated in a single entry system. Imagine you total up all your business assets at year end, then subtract any liabilities. The result is your net asset value. By comparing this value to what you had at the start of the year, you can see if you made a profit or a loss. This approach works well when there's no tax to pay and only a few owners involved. It's simple, but it doesn't provide the detailed tracking that larger businesses need. Let's look at a practical example. Suppose you start a business with $100,000. You buy goods for resale, pay for delivery and rent, and then receive proceeds from your sales. Each transaction is recorded in a simple cash book. At the end of the period, your cash balance is $148,000. Subtract your initial capital, and you find a profit of $48,000. This method is clear and direct, perfect for a business with only cash transactions and no other assets or liabilities. Now, let's expand the scenario. Imagine you purchase a delivery van for $10,000. Your cash book now tracks not just cash, but also assets like vehicles. After all transactions, your cash at bank is $138,000, and your delivery van is worth $10,000, totaling $148,000 in assets. The profit remains $48,000, just as before. This example shows how single entry can be adapted to include simple asset tracking, but it still lacks the depth of double entry accounting. Let's complicate things a bit. Suppose your supplier allows you to pay for goods later, creating a liability or creditor. You receive the goods, but haven't paid yet. Your cash balance increases, but you now owe $40,000. When you subtract this creditor from your total assets, your net assets remain $148,000, and your profit is still $48,000. This example highlights how single entry can handle simple liabilities, but tracking becomes tricky as transactions grow more complex. While single entry accounting is easy to use, it has clear limitations. It doesn't provide a full picture of your business's financial health, especially as your operations grow. Tracking multiple assets, liabilities, and complex transactions becomes difficult. Errors and fraud are harder to detect, and preparing for taxes or audits can be a challenge. That's why most businesses eventually switch to double entry accounting as they expand. Bridge the gap. Many beginners start with single entry and gradually move to double entry as their business grows. Tools like color-coded charts of accounts can help learners identify where each transaction belongs in the general ledger. As you become more familiar with accounting, you'll rely less on these aids and more on your understanding of the system. Double entry may seem complex at first, but it's essential for accurate, reliable, and scalable financial management.